Hello, my name's Chris Gosselin from Australian Fund Managers. Today we're talking to Monik Kotecha, Chief Executive Officer of Insync Fund Managers. Insync has been around since 2009. They invest in a global portfolio of what they call megatrend companies. Monik, good morning. Nice to see you. These are extraordinary times. Just talking about your funds before, you have two different strategies, or it's actually the same strategy, is it not? But one has protection and one doesn't. It's the same basic portfolio. Tell us more about it.
Hi, Chris. Yes, that's exactly spot on. So we've got two funds, similar strategies in terms of the way we pick stocks. So both funds have around 30 stocks exposed to 14 global megatrends. And then we tend to be fairly fully invested in both funds. But the difference between the two funds, there's one feature. So we have, in a sense, a long-only strategy, which is a global quality strategy, and a global capital aware fund. And the difference between the two funds is in the global capital aware, we have an additional feature, which is providing downside protection through buying index puts.
So in this environment, Monik, that protection is particularly important. I think it's something that all investors are suddenly rushing for. I mean, you've had good performance over the past 12 months, 13 months in both your funds, but the protection is the really important part. Tell us how you went in February.
Absolutely. So if you looked in February, the funds were about 400, pretty close to 400 basis points ahead of the benchmark. And then if you look at the 2 months to sort of the most recent unit price, so from the start of February till the, let's say, March the 25th, we were about 650, 700 basis points. Obviously, it changes every day, but that's about the ballpark to go ahead of the benchmark. So that's really consistent with our history. If you look at our history, particularly the last 3 years, those mega trends and the growth, the growth companies we've invested in, the profitable growth companies, have delivered a greater than market return. But in this down market period, consistent with past periods, we've only captured 50% of the downside. And our current numbers would suggest we're broadly in that ballpark figure again. 50 to 60% of the downside is what we're capturing at the moment in our protected fund, Chris.
So just looking forward, I mean, these are extraordinary times. Economies are obviously going to be hit, and companies are going to be hit to varying degrees. Why do you think the companies that you're invested in will be more protected or provide better returns than the market as a whole?
Yeah, thanks, Chris. I think foremost, I think it's probably important to say up front that this is obviously a huge human tragedy, and we shouldn't all, and I certainly am not losing sight of the fact. But having said that, at periods like this, as has occurred many times over the last 30 years, whilst I've been involved in managing money, and certainly over longer periods of time, we get panics and we get crisis periods. And certainly fear and human emotion takes away. And I think it's very important during this process just to step back and take control of the situation, control your human emotions, and try and understand the path forward. So if you look at the businesses that we own, as I said, our businesses tend to be tied to global megatrends. So obviously everything is tied to the economic cycle. And obviously what we're experiencing today is truly unique in the sense that a lot of businesses have actually been shut down for a temporary period of time. Having said that, when the economy, which we believe will start recovering for a number of reasons, where you want to be positioned is again on those mega trends, because those mega trends have not gone away. But importantly, as you're investing in those mega trends, it is absolutely critical you buy the highest quality businesses. These businesses have incredible amounts of underlying profitability, cash flow generation, and really importantly, robust, almost bulletproof balance sheets and cash flow. So they can ride through what the world is experiencing at the moment, and will probably come out at the other end in a stronger position than they were actually going into this crisis. So So we believe that owning those portfolio of 30 companies exposed to those 14 mega trends strongly suggests that when the recovery comes through, they will participate in that recovery as it comes through. The other key point to make is if you look at the broad strategy over the long term, it is consistent with the strategy we have in place, the quality-based strategy, in the sense that it does tend to pick up a lot of the market upside. But interestingly, for a lot of the downside period we've recently experienced, the stocks have actually outperformed the market as well.
Is it also true that when we do come out of this, and hopefully it's sooner than later, but all the indications are that this has got at least 6 months to run, markets will run ahead, but the companies that you're investing in are liable to be in a better competitive position than those companies that don't have those attributes you're talking about? So a strong balance sheet, profitability, good distribution in their particular markets.
Absolutely. If you look at a lot of our businesses today, the average return on invested capital, which is our measure of quality, it's a financial measure. You can almost not dispute it. It's there. We can talk about management and market positioning, and they're all very important attributes. But when you look at the underlying profitability based on the return on capital measure across the portfolio, it currently sits at 50%. Okay? Many of our businesses are debt free. Interesting, a lot of those businesses will continue to perform well even during this crisis period. So, for example, one of our big mega trends, one of the 14 mega trends, is the pet humanization mega trend, where we're increasingly treating pets like humans. So we're spending an increasing amount on their health and welfare. So this is about looking after the medical needs and ensuring they're getting the right quality food, sometimes as good, if not better, than what we're eating today. So that trend has been in place for many years. It's been growing at mid to high single digits, multiples of GDP. And during this downturn, consumers will continue to spend and look after their pets. Okay? So despite the fact that the share price has fallen, the underlying business is probably still growing through this period of time. So there's a huge dislocation between the underlying growth in value that's coming through and what the share price is currently reflecting today, which to us suggests that some of these businesses in our portfolio today represent, going forward, at these depressed prices, an outstanding investment opportunity to generate some good, consistent returns. Another stock that is dominant in our portfolio, it's a large position. Typical large positions, our portfolio tend to be 4 or 5 positions in size, and we have a number of them, is Dominos Pizza. And clearly, the attractions of Dominos Pizza is it's a takeaway home delivery business. It's one of the most digitally enabled restaurant businesses, if not of any business, entering the world today, where they can deliver a hot pizza to your front door very, very quickly. And in this environment where we're obviously experiencing increasing stages of social distancing and potential lockdown, where they're still allowing home delivery and takeaways to occur, there's a business with high levels of profitability that will continue that is performing very well today and is in a strong position to continue to grow their franchise once the economy starts to recover. Another business which we believe will recover very quickly and is probably starting to recover already because of its exposure to China is Este Lauder. Now, beauty or beautification is again another powerful megatrend that's been growing at multiples of GDP. And there's been a number of drivers behind that trend. So we've obviously got social media and the fact, like today, not sure how good I'm looking today, but I haven't put any makeup on. But certainly more and more people with social media are obviously spending a lot more on skincare products and looking to look more attractive. Obviously, the aging population, there's a big drive towards skincare there. And now over the next 10 years, you've got 600 million people in India entering the emerging middle class. That's going to add to the burgeoning middle class we're already seeing in China. And they're spending increasing amounts on premium cosmetic and skincare products. So again, there's a business that's very strongly exposed to China. And now that China it has started to recover. We would anticipate that their sales will start to increase and that trend to start reasserting itself. So there are some examples of businesses in mega trends that we believe are continuing to perform well. And when we come out of the recovery, those businesses that are leaders in those trends will outperform.
Monik, on behalf of Fund Monitors and all our viewers, I'd like to thank you very much. Good luck through these difficult times. I know you're working from home, I'm working from home. I think one of the benefits of the financial services and the fund management businesses, they can disperse and work remotely. So it's business as normal as much as it's business like we've never known it before.
Absolutely.
But we can still operate. I wish you all the best. Thank you for talking to us today.
Thanks, Chris. Stay safe and look forward to speaking to you again.
Okay. Thank you. Stay safe.